All right, let's jump right in. Today we are doing a complete financial deep dive on Deckers Outdoor Corp. You probably know them by their ticker symbol, DEC. And we're going to try and answer one central question. Based on all the hard data, is Deckers stock a potential bargain at its current price? We're going to dig into the numbers, stress tests and valuation models, and really just let the financials tell the story. Now, you almost certainly know their products. I mean, maybe you even own a pair of Uggs or Hokas. But today, we're not talking about fashion. We're pulling back the curtain to look at the financial engine that's powering these massive brands. Okay, so first things first. Before we can even start talking about valuation, we need to understand exactly what Deckers is and where it sits in the market. So, Deckers operates in the consumer cyclical space. All that really means is its fortunes can kind of rise and fall with the broader economy. But what's really telling here is who owns the stock. We're talking the biggest names in the game: Fidelity, Vanguard, and BlackRock. That tells you right away that some very serious players are paying close attention. So, we know who they are. Now for the fun part. Let's see how they're actually performing financially. This is where we get into the nitty-gritty. First off, just wrap your head around the sheer scale of this operation. Total annual revenues are over $5.2 billion. Yeah, this is not a small-time player. We are talking about a massive global enterprise. But making a lot of money is only half the story, right? You got to ask how much they actually keep. Well, their net profit margin is over 19%. For a company that has to physically make and ship products all over the world, that is an incredibly strong sign of profitability. It means they have powerful brands that can command premium prices. And this number right here, perfectly illustrates how efficient this company is. A 43% return on shareholder equity is, frankly, incredible. It means for every single dollar that investors have put into the company, management is generating over 43 cents in profit. That is just extremely effective. So when we look at all the metrics together, a really clear picture starts to form. We've got a large $15 billion company with a PE ratio that suggests a pretty reasonable valuation. And on top of all that, it's still posting solid, high single-digit revenue growth. You know, it's that stable yet growing profile that investors are always looking for. The company is clearly performing well, but what does that actually mean for its stock price? Is the market seeing all this strength? Let's find out. You see, to really figure out if a stock is a bargain, we have to go beyond the current price and calculate its intrinsic value. You can think of this as what the company is fundamentally worth, based on all the cash it's expected to generate for the rest of its life. One of the best tools for this job is called a discounted cash flow, or a DCF model. So we ran the numbers to create a range of potential values. You can see them here. A pessimistic bear case, an optimistic bull case, and our most likely scenario, the base case. And that base case analysis, our most realistic scenario, spits out an intrinsic value of $166 per share. Go ahead and keep that number in your head. Now, let's compare that to the stock's recent market price, which has been hovering around $105. The difference there is, well, it's pretty stark. And here's the crucial point. Our main valuation model is suggesting that the stock is trading significantly below its estimated fair value. We're talking about a potential $60 gap between the price and the actual value. Of course, we wanted to double-check our work, so we used a second valuation method based on earnings per share. And as you can see, this model pretty much confirms the thesis. The moderate case points to a value of $123, again, way above the current price. So that's two different models, both pointing to a similar conclusion. So now, let's take a quick look at the core financial statements that drive this entire analysis. This is the raw data, the numbers that are actually telling the company's story. What you're looking at on the income statement is just a powerful and consistent growth story. I mean, look at that trend in both top-line revenue and bottom-line profit. Revenue is up by more than 50% in this period. And net income, it's more than doubled. That is some impressive acceleration. Now let's move over to the balance sheet. The foundation here looks rock solid. The company's assets and its total equity, which is basically the net worth of the business, are both growing steadily, year after year. This is what a financially sound and expanding company looks like. And finally, the cash flow statement. You know, this might be the most impressive slide of all. Deckers is a true cash-generating machine. Look at that free cash flow. That's the cash left over after everything. It has just exploded. growing from $121 million to nearly $1 billion in just a few years. That's almost an 8-fold increase, and it gives the company so much financial flexibility. So, after digging through all of this data, through the performance metrics, the valuation models, what is the final conclusion from our analysis? Well, the takeaway is a pretty clear and simple thesis. Deckers is a financially robust, highly profitable, and growing company. And based on 2 separate analytical models, its stock appears to be trading at a pretty big discount to what it's actually worth. But no analysis should end on a purely positive note. The numbers look great today, but the critical question for any investor is always, what's next? What are the potential risks? What challenges in this fierce consumer market could change this whole positive story? That's the crucial thought to leave you with.